Hi there. So this video was going to be on another pension related subject, but following on from the events this week, I thought it would be a bit off to ignore what's going on in the world. Everyone's concern is first and foremost with the people directly impacted, but it's natural to think about how events like this might affect you. So this episode's going to be a little bit different. It's going to be a bit more of a chat where I just talk about what it's like investing through uncertain moments like this. I've no idea if it's going to be useful, but I want to talk more generally in a more conversational way, just me and you, so to speak, chatting about how things are and my take on what you should bear in mind. And in no particular order, here's a list of a few things which I think is important to consider when faced with uncertain times. I'm not going to give sound bites of short-term market commentary, supply chain issues, inflation, all the rest of it. In my view, that's unnecessary detail which misses the main point. I hope this video will be as relevant now as it might be the next time something happens. So point number one, I feel it too. One of the things that I think we sometimes get wrong as financial planners is that we sometimes dismiss that very human feeling when we have uncertain moments like this. And I want to be clear, when you see stuff like we've seen on the news, it worries me too. The truth is that feeling in the pit of your stomach, you know, that one that set up camp in 2020 hasn't really left, that's worry. And that's completely normal when faced with times like this. I don't care how experienced an investor you are, we all remain humans. And I don't think it's healthy to completely ignore or silence that worry. There will always be that little voice which thinks this time is different. The thing is, though, we do need to remember the phrase that the market climbs a wall of worry. Investing has always been this way. Do you remember when I said a long time ago in an earlier video, you are paid for the uncertainty? Well, look, that uncertainty is cashing in its chips today, and that's okay. The skill of becoming an experienced investor is that you come to realize, despite how each event is different, the uncertainty isn't. You just need to recognize that and be like, good to see you again, old friend. What we can't do is we can't let ourselves lose sight of the main goal of why we're investing. And this is generally for our future. It's just fuel to achieve what you want to do in the future. Which leads me on to the second mistake, which is timing is a waste of time. So one of the oversimplifications that comes up is, well, look, things are uncertain, let's move to cash. In fact, there was even an article in the press this week with the headline, something like move 50% to cash, says some investing expert apparently. Okay, so let's just go over the points briefly here for a laugh. And there are a lot of points here, so I'm going to go over some of the ones that I thought were ridiculous. Decide immediately whether your attitude to risk has changed. Or better put, panic and make a big mistake at selling at a loss. The thing is, when stuff like this is why a financial planner who actually cares about you is worth their weight in gold. We can stand between a decision like that. Self-serving comment, yes. Untrue, no. The thing is, if your attitude to risk has changed because the market's gone down, it was never right to begin with. It was actually, okay, I'm happy to take the upside, but I will run away from the temporary declines. We just can't react to the markets each time they do their thing and change in value. Investing is first a discipline and then a practice. Anyway, the next one that they mentioned as a suggestion was have a clear stop loss strategy and make sure you apply it. So just to add to this, where they suggest you should cut your losses, as it says, and their guide was, there's no perfect answers, but an effective level tends to be 10%. What, are we day traders? This is absolute madness. And there are many things wrong with this article, but the biggest concern is that some people will read that and probably act upon it. So let's just put this into context and use one of my favourite graphs, if that's such a thing. It's from JP Morgan's Guide to the Markets, and it shows the year of annual returns for the S&P 500 and the intra-year declines. So what the declines were each year, that's the red dots, and the bar above it is the end annual return. My point here is, can you see how many positive years have had declines of 15 and 20%? Volatility is a totally normal feature of the market. If you start playing cash in, cash out, you are just passing your hard-earned money onto the folks of Wall Street and they will gladly accept it. What's even more eye-opening is that there's been previous studies saying that the 6 best performing days in the market often occurred within 2 weeks of the worst days. And we haven't even really seen big market movements in this event. I'm just trying to drive home the principles of It's madness to try and time these things, and no one, apart from Jim Simons, ever has been able to do it successfully over the long term. The problem is that when you break it down, markets just don't work like that. And what you're actually doing is, let's say the market actually does drop, and that is the news that's being priced in at that time. If it was certain that the market was actually going to get much worse, what would happen is you wouldn't be the only one who knew that. The price would reflect this. So the fact that the price is where it's at automatically means that there is some uncertainty on either side. So actually what you're saying, if you move to cash and you want to be in the market long term, is I think the market will drop further, and I know better than the collective knowledge of all market participants. And assuming you aren't now happy sat in cash for the next 30 years, you're also saying, I also think that I can get back into the market faster than the market can price any changes. And remember, even when there's a large drop, the spring back can be equally quick. So, good luck getting that Bloomberg terminal into your spare room. So this is the final one here is, I don't really want to give this a time of day, but it's so bad that I thought I'd have to talk about it. Don't go on holiday and be out of contact with markets if you have large investments.
What?
Just remember, if you are investing, it's about your and your family's future. And if you're doing it right, it should be over many, many years. So bear in mind with the media in general, is that they're playing their own game where they want to attract attention. They do not necessarily have your long-term financial interests at heart. Number 3, you still own everything you owned yesterday. This is probably the thing that's underappreciated with investing. You own everything you owned before the market went down. That is always the case. The market has just decided at this point to price it in this way. We know based on history, as long as the investment is set up in the right way and diversified between a mix of the great companies all across the world, every single event so far has proved that it's not only come back, but gone on to generate very strong returns. I would actually argue that the only thing that's actually making you uncomfortable is your ability to log in to an app and do something. So let's expand on this. I'm going to use our good friend property investment to show how crazy this actually is in reality. Let's say you own quite a few buy-to-lets and they're set up right and they're a good investment. Now, because Mr. Putin has decided to do what he's done, you've now got a frantic house buyer going from door to door saying, I'd like to buy the house, but because of what's going on, I'm going to give you 20% less. Would you even think about that? Does it not seem a bit absurd? And I know it's a simplification, but you'd be like, no thanks. Still a good investment. It's almost behavioural insurance. It's harder to react in times like this. I would argue, though, that we can't let behavioural failings shape our investment decisions. Number 4, all past declines look like opportunities and all future declines look like risk. Morgan Housel. This is factually true, and depending on your age who's watching this, maybe you remember Black Wednesday, maybe the tech bubble, 2008, or maybe it might just be easy to think back to March 2020. At that time, it was pretty scary. But we now recognise that dip was a buying opportunity. But we forget to mention that what it was to buy at the time took a lot of bravery. This is why most investors underperform. Because what happens is everyone sits back in the good times and they say, yes, I will be greedy when others are fearful, but actually they discount the fear at the time and how that might impact them. So let's have a look at this graph here. I'm sure each one of these events felt like a real risk at the time, and because they were. And do we really truly feel that this time is different? Or is it more likely that despite what's going on, companies will still exist, we'll need to make a profit, and our way of life will continue? So, brings me on to number 5. Nothing has changed. So you don't need a financial planner to know why you're investing, but we certainly can help clarify what's really important to you. So let's assume that you have a financial plan which aligns your capital, your money, with your goals, what you want to do, your values. Here's what we'd do if you were concerned when the market had dropped. We'd ask, do recent events change the long-term plan? That's almost always a no, because any financial planner has built in a margin of safety. Basically, we planned for things not going to plan. Has these events changed your goals? So actually the pandemic might be a good example. Yes, the market was volatile, but actually what came out of it was actually maybe I want to change my life, my work-life balance and all the rest of it. That's a change of goals. But for most people, it's probably going to be no. Despite the challenges of today, do we think companies will stop making money? Do we really think that our way of life, the market system, will stop working? The answer is almost always, actually, look, this is a bit scary, but nothing has changed. So, in summary, this has just been my views, but remember, with investing, it's not easy, it never was. But every good long-term investor has been in this position before when things get uncertain. This could be your first time, but the great thing is each crisis or time you go through like this, the better you become at handling it. It's just to say the most powerful action you can sometimes take is doing nothing. And remember, it's not investments that get tested in times of uncertainty, it's investors. Thanks for watching.